Chapter 9. The Skinny on Bonds. Having read the preceding list of non-correlated alternative investments and arbitrage plays in Chapters 7 and 8, you now may have spent more time studying portfolio construction than most advisors on Wall Street. All portfolios should have some contrarian, against-the-grain assets that run counter to the broader trend. This chapter is devoted to one of the vastest and most diverse asset classes, bonds. They come in an astonishing array of shapes and sizes and durations, not to mention issuers, yet all of them share some underlying traits and risks. Insisting all portfolios should own some bonds is a dubious proposition. The fact is, I don't like bonds very much, and a lot of portfolios can do just fine without them. I rarely buy them, the exception being Dr. Pepper and Colt 45 high-yield bonds in the early 90s. One study of the biggest endowments and pension funds found that bonds occupied only 7% of their portfolios. The idea people have that bonds are safe bothers me. Safe from what? Safe from capital loss, okay, but they have plenty of risks of their own, and the largest risk is the loss of purchasing power. That is the most unforgivable flaw of bonds. They fail to keep up with your COLA and the rising prices in your life. That flaw deeply offends me. I cannot help it. It makes me think of my late mother and her struggles to keep up with inflation at the end of her life. Municipal bonds and government bonds are the biggest laggards in this regard. My advice to clients is that they never should buy Treasury notes of 1-year, 2-year, or 3-year durations. They are certain to lose ground to the rising cost of living. Same goes for a 30-year government bond. Bond yields and rates track the rising prices as measured by the Consumer Price Index, because the higher the rate of inflation in the economy, the higher the interest rates that borrowers must pay to make the promised returns attractive. If you buy a 1-year Treasury bill paying a 5% interest rate, and a year later the going rate is 6%, your bill is worth less. If you buy a 30-year government bond and hold it to maturity, you will have lost a startling amount of purchasing power in that time. It is clear that stocks outperform bonds over the long term. Bonds are an okay non-correlated counterbalance, an afterthought to cushion the ups and downs of the equities that anchor a portfolio. The Wharton finance professor Jeremy Siegel studied the prices of stocks, Treasury bonds, T-bills, gold, and the U.S. dollar from 1802 to 2012. How's that for long term? In those 210 years, stocks had average annual returns of 6.5%. Treasury bonds, with durations of 2, 3, and 5 years, had half that return at 3.3%. And T-bills, bonds lasting less than a year, had an even lower annual return of 2.7% after adjusting for inflation. That gap between stocks' superior performance and bonds' pokey pace is even bigger than it looks, compounding over the decades into a huge windfall and higher returns for the owner of stocks. Siegel also found that stocks are less risky than government bonds for holding periods of 20 years or longer after adjusting for inflation. Recall also that in the 15 years leading up to year-end 2011, 10-year Treasury bonds kept pace with inflation less than 20% of the time, and investors were down 25% in purchasing power by the end of that period. Given government bonds' lackluster returns and their failure to maintain full purchasing power amid rising prices, perhaps corporate bonds offer a better alternative. Just one problem: corporate bonds, those of the highest quality, trade like government bonds, and also lose pace to inflation because of the low interest rates they pay. I'm talking about corporates with a credit rating of single A or higher. Corporate bonds at the double B level or weaker are an entirely different beast. and these distressed bonds pay significantly higher rates to compensate for their supposedly higher risk of default, which can be overstated even in these days of hyper-connected information flow. If you own bonds rated BBB or higher, you have what is known as bank credit, and the bonds are affected, for the most part, by the rise or fall in interest rates in the broader economy. That's it. Put money into lower-rated BB bonds or worse, and changes in interest rates have very little impact on them. The main issue is the credit quality of the company and how strong its balance sheet is. Despite my misgivings about bonds, one good thing about them is their due date, whatever it may be. Whether it is a mere 3-month Treasury bill, or a 2-year note, or a 30-year bond, or something in between, the contractually committed promise to repay you on a particular date of maturity is an extra measure of safety. That is the good news. The surprising exception is that, while buying a bond is investing in debt, when you invest in a bond fund, a basket of dozens or hundreds of bonds of various issuers, types, durations, interest rates, and terms, you aren't investing in debt and bonds at all. Instead, a stake in a bond fund is an investment in equity, like a stock is equity, because you essentially are buying shares in a bond fund owned by a company, which itself is the owner of the individual bonds. A bond fund has no maturity date, no guaranteed payback by an agreed-upon deadline. Therefore, any extra measure of safety offered by bonds themselves is absent when they all are cobbled together in a broad fund, supposedly aimed at reducing the risks of owning any one bond. Also, while you shop for bonds mainly by looking at the interest rates their issuers pledge to pay, the real thing to watch is the fluctuating prices of bonds in response to interest rate movements, economic conditions, crisis headlines, and the like. In 1994, most bond funds lost a jarring 19% of their value in a single year, because most bonds are sensitive to interest rates, and rates were on the rise. Yet bonds supposedly are less volatile investments than stocks. The original buyers of bonds typically sell them off before the bonds reach maturity to pocket profits if possible and reinvest them in the next round of bonds at the latest interest rates. In a crisis, a U.S. Treasury bond is especially non-correlated to the stock market. The bond can surge up in price, letting the owner take profits by selling to the next buyer. The next buyer is willing to receive the lower effective interest rate that results from the higher price he just paid to grab onto something safe. Though bonds can be a losing option, nonetheless I discuss their types, risks, and upsides in the rundown that follows. Before an investor shuns any particular investment, it is important to understand what he or she is shunning. Let us begin with one of the biggest categories of all. Government bonds. Bonds are debt securities issued by governments, utilities, school districts, companies, and the like. An investor puts up, say, $100,000 to buy a bond from the issuer. The issuer pays interest on that debt at a set rate in quarterly or biannual installments until the bond comes due, reaches maturity. Then the issuer must pay back the entire original sum to whoever holds the bond, based on the $100,000 face amount of the bond when it was issued. Once a bond is floated, it can trade on the open market at fluctuating prices. If buyers seeking safety bid up the price of the $100,000 bond, paying 2% interest, so that the price suddenly jumps 10% to $110,000, its interest rate now pays only 1.8% to the new buyer. This is because the bond continues paying the same old rate of $2,000 a year in interest, which now amounts to only 1.8% of the now higher purchase price of the bond. This is why bonds and interest rates are said to have an inverse relationship. When a bond's price rises and it gets sold to the next buyer, the effective interest rate it pays is suddenly lower than originally promised. When bond prices fall, the preset interest rates they pay increase commensurately in terms of their new yield. Moreover, existing bonds must compete for investors' capital with newly created government bonds paying the latest interest rates. After years of straitjacketing by the Federal Reserve, interest rates currently are rising, so each new batch of bonds may offer higher rates. This would depress the price of existing bonds paying a lower rate, causing investor losses for those who sell their old bonds at lower prices than they paid for them originally. The U.S. government is one of the most prodigious bond issuers on the planet. Treasury bills cover terms of less than a year. Notes are issued in 2-year, 3-year, 5-year, and 10-year increments, and Treasury bonds are 30-year instruments that were reintroduced in 2006. The shorthand bonds is a catch-all for all of the above. Keep in mind that the supply of U.S. bonds is unending and inelastic because our government, past, present, and future, spends so much more than it takes in from tax collections. The U.S. government spends hundreds of billions of dollars more every year than taxes haul in, and it covers this shortfall by selling bonds. This overspending constitutes the annual budget deficit. We cover this shortfall by raising money from bond investors. Thus, each budget year's deficit and the bonds the U.S. sells to cover it add to the long-term national debt owed by the U.S. government. For decades, spending by the federal government has occupied an average of 21% of our national GDP, yet tax collections amounted to only 18% of GDP on average, with a low of 14% in the meltdown of 2008 to 2009. The annual deficit hit the $1 trillion mark for the first time in fiscal 2009 and stayed above that level for 4 years, declining to $438 billion in fiscal 2015. In fiscal 2019, it is estimated to exceed $980 billion. To cover this gap, Congress charges it to the government's credit card. It lifts the debt limit so that the U.S. Treasury can issue new government bonds to raise money now, promising to pay interest on it until we repay the entire principal. Usually, government pays back the old bonds by selling more new bonds and accumulating more debt. This borrowing to cover each year's deficit adds to the accumulating mountain of loans the government eventually must repay. If ever the U.S. were to default on its bond payments, it might trigger a worldwide panic spreading at the light speed of fiber optics. The result of this chronic overspending was $10 trillion in debt owed to bond investors by the federal government, racked up from the birth of our nation until 2008, at the end of 8 years of George W. Bush and the wars in Afghanistan and Iraq. In just 1 decade since then, we have doubled the national debt, adding $10 trillion more to hit the $20 trillion mark. It is a staggering amount, equal to 100% of GDP. Worse, we raised a lot of that money by borrowing from countries that compete with us or outright hate us, by selling them U.S. government bonds. China is said to own close to $2 trillion in U.S. bonds and other U.S.-based assets. That hefty stake might look like some kind of a chokehold on America, yet one is reminded of an old line attributed to the billionaire J. Paul Getty: "When you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem." Thus, China's massive investment in U.S. debt and other things American neutralizes it as an existential threat to us. We owe the Chinese government so much money in U.S. bond obligations that China cannot afford to nuke its own assets. So there's that. Government bonds can be a good hedge against plunging stock prices. When stocks began tumbling in a rapidly spreading virus of fear in the great meltdown of 2008, Institutional investors pulled out of stocks and corporate bonds in a flurry and funneled the money into Treasury bonds. This panic sent the price of 10-year Treasuries shooting higher, which further reduced their effective interest rate. In July 2007, before the troubles started, 10-year Treasuries were yielding more than 5% annual interest. The rate plunged by more than half to 2.16% by December 2008, with the crisis fully raging after the collapse of Lehman Brothers. The 10-year Treasury bond surged to almost 3.9% by August 2009, but fell back below 2% in 2011, tamped down by the Federal Reserve's aggressive bond-buying program, quantitative easing. QE aimed to create more demand for bonds to bid up their prices and thereby tamp down interest rates, and by 2012, the 10-year rate was back down to less than 1.7%. QE ended in October 2014, and by the summer of 2018, the 10-year rate was back up to almost 3%. In the meltdown, investors were willing to take a much lower return on government bonds, meaning a lower interest rate, to have the assurance their money was safe. The U.S. government remains the best bet to pay them back, because if it ever runs out of money to make its loan payments, it can always avoid a default by revving up the printing presses to cover the obligation. This would, of course, trigger an onslaught of inflation. The surge of new money into the economy would find new uses, driving up prices. While U.S. government bonds are seen as having the lowest risk since they are backed by the full faith and credit of the U.S. government, he said, whistling past the graveyard, other governments have a higher risk of default, especially those in developing countries. Ecuador, Grenada, Argentina, Indonesia, Pakistan, and most recently Venezuela all have defaulted on their debt in years past. Now, almost a decade after the Great Meltdown, the U.S. economy is much stronger under President Trump, whether you like him or hate him, and there seems to be no in-between. Investors are bolder, betting on more risk rather than less, and the 10-year Treasury rates reflect this preference. The Trump rally sent stocks up strongly after his election in November 2016. On Election Day, the Dow Jones Industrial Average was at 18,332. By the end of January 2018, the index was up to 26,616, an astounding 45% in 15 months, and the 10-year Treasury bond was at 2.66%, up from 2.15% in early November 2016. In the following year, the Dow average fell as low as 22,445, and by early 2019 was back near the 26,000 mark. While the federal government issues federal bonds, states, cities, towns, and local utilities issue municipal bonds. Investors can buy government bonds directly from the U.S. Treasury or through a bank, dealer, or broker. For small investors, mutual funds offer an easy way to invest in government bonds. As is true for all government bonds, inflation is a key investment risk. As inflation goes up, investors risk losing purchasing power. You can eliminate this downside by investing in inflation-indexed bonds. Another risk of bonds is that rising interest rates elsewhere will make their lower rates less attractive, and so their price will take a tumble, hurting their holders if they sell at the lower prices. Other kinds of bonds. Corporate bonds are issued by companies looking to raise new money now in exchange for slow, steady interest payments that can go on for anywhere from 1 to 100 years. The interest paid on a corporate bond can come in 4 flavors: fixed, floating, zero coupon, or adjustable. Fixed will pay you the promised rate until the bond finishes its run and comes due. Floating-rate corporate notes are preferable in times of rising interest rates because the interest rate they pay resets and rises with the rest of the market. Technically, these notes are direct loans rather than full-fledged bonds that are sold and traded on the public markets. Floating notes base their changing rate on LIBOR, an international interest rate among giant banks, or the federal funds rate, the base rate on banks' overnight lending to one another set by the U.S. Federal Reserve, or some other formal reference point. Zero-coupon bonds, unlike the fixed and floating corporate bonds, pay no interest at all. Instead, you buy them up front at a discount to their face value and receive the higher face amount at the end of the term. The gap between what you paid and what you received is your de facto interest rate. Intriguing example. In 1984, quarterback Steve Young spurned the NFL draft to join the new USFL Football League. The LA Express signed him to a $40 million contract to be paid over 43 years. The team paid him a $4 million bonus up front versus $1 million offered by the NFL's Cincinnati Bengals, plus less than $1 million in salary in 4 years. The remaining $30-some million was to be paid in the ensuing 37 years, even if he left the team. That is one heck of a zero-coupon bond. The deal with the USFL went kaput 1 year later, and Young pocketed $4.8 million and signed with the NFL's Tampa Bay Buccaneers. Wall Street is especially inventive in crafting hundreds of different ways to do the same thing, raise capital, generating fees on all of them. Thus, corporate bonds come in many varieties. They can be callable or non-callable. Callable bonds let a company redeem them before they mature, therefore paying a higher rate than non-callable bonds to compensate for any chance of a surprise call-in. You also can invest in convertible bonds that can be exchanged for company stock, although this makes convertibles vulnerable to stock price movements, and usually we want bonds to offset stock risk rather than be affected adversely by it. Bonds also can be investment grade or below, non-investment grade, based on creditworthiness ratings issued by firms such as Moody's, Standard & Poor's, and Fitch. This is where bonds, so staid and colorless, suddenly get sexy. The non-investment grade corporate bonds pay a significantly higher rate than the blue chips to compensate investors for being willing to take on a higher risk that the companies might falter and default on their bond obligations. In the 1980s, Michael Milken and his bankers and traders at the old Drexel Burnham Lambert figured out a secret before everyone else, that these lower-rated bonds, disregarded by investors and therefore having to pay much richer rates, actually were far less likely to default than feared. This made them a deceptively attractive investment vehicle. Investors could reap double-digit returns on bonds that defaulted less frequently than conventional wisdom held. Thus, the junk bond boom was born, financing the 1980s takeover frenzy that saw high-yield bonds finance the leveraged buyouts, takeovers, and empire building of RJR Nabisco, Revlon, MCI, Turner Broadcasting, Fox Television, Phillips Petroleum, Union Carbide, Federated Stores, Beatrice Companies, and Safeway, among many others. Wall Street loves a good nickname like junk bonds, although practitioners prefer the term high-yield bonds. They traverse in a limited alphabet of bond ratings, below the august AAA corporations at the top, and even below the rungs of B and BB. In line with S&P and Fitch ratings, high-yield bonds are those below the BBB rating, even down to C and D, representing the lowest grade junk. Investors can get exposure to high-yield bonds through individual bonds, although mutual funds and exchange-traded funds are a better doorway for retail investors because the bonds are managed by professionals. By Moody's reckoning, the historical annual default rate on high-yield bonds currently stands at 4%, so 96% of the time you can be confident of avoiding any default. In high yield, the bigger risk is that volatility in the bond's pricing can crush your capital, particularly in terms of increased global uncertainty. The reason for this is that companies with a low credit rating find it much more difficult to secure financing in a crisis when lenders have a greater fear of getting stiffed. This uncertainty can trigger a sell-off of high-yield bonds, making matters worse. Elsewhere in the world of inventive forms of debt, the international fixed income market offers investors an opportunity to diversify their portfolios, mitigate currency risk, and reap a higher rate of return than local debt securities offer. Downside, they also carry a greater risk of default, especially when linked to developing countries. International fixed income instruments can include global bonds, foreign bonds, and euro bonds. A global bond refers to a type of bond issued in multiple countries at the same time, usually by a multinational corporation or sovereign entity with a strong credit rating and huge capital requirements. A global bond issued by a U.S. entity in China will be denominated in Chinese yuan. A Chinese company selling bonds in the U.S. will promise to pay back in U.S. dollars. A euro bond, meanwhile, refers to any bond denominated in a currency other than that of the country where the bond was issued. A good example is a yen-denominated bond being sold in the European financial markets. Both individual and institutional investors can invest in international fixed income through mutual funds or individual bonds. Senior rate floating notes, which usually are issued by firms with poor credit ratings, pay a variable interest rate generally tied to a money market reference rate, such as the federal funds rate or LIBOR, plus a quoted margin. Senior refers to a promissory note that takes priority in payment should the issuer go bankrupt. In times of high interest rates, floating-rate notes have higher yields than fixed-rate notes, which are a better option in times of falling interest rates. You can buy individual senior-rate floating notes or invest through mutual funds and ETFs, as with so many asset classes. They are especially worthy now as the Fed starts raising interest rates after a decade of dormancy. Currently, the U.S. economy is growing faster than the rate of 2% or so for the previous decades, and in an economy with stronger growth, interest rates tend to go up rather than down. Bond risks revisited. Bonds mistakenly are considered a safe investment because most times the investor gets his or her money back, especially in the case of bonds issued by various levels of government in the U.S. Yet bonds can plunge in price on sudden shifts in consumer sentiment, demand for stocks, and most of all, changes in interest rates. The truth is that bonds carry their own unique set of risks, and it is vital to understand each of them. Bonds are safer compared with some other investments, but less safe than others. Understanding bond risk is crucially important in these Fed-dominated days of the bond markets. Though we have touched on bond risks earlier, it is a topic worth revisiting in detail here. 6 major kinds of risk can affect your bond returns: maturity risk, interest rate risk, reinvestment risk, liquidity risk, ratings downgrade risk, and credit default risk. To break them down further, maturity risk may be the most important one. A bond is known as a fixed income security because the investment pays a fixed rate of interest on the principal amount until the bond matures. Available maturities range from 30 days all the way up to 30 years. When you buy a bond, you are taking a risk that interest rates elsewhere might rise in the time you hold that bond. Buying a bond with a longer waiting period to maturity increases that risk. So if you buy a 30-year bond that pays, say, 6%, you may think of yourself as a genius. But if interest rates pop to 15% or higher, as they did in the late 1970s, then you will be kicking yourself. Alas, if you buy a short-term bond to reduce the chances of this happening, you aren't taking much risk, so you won't earn much yield. That's why it's a good idea to be diversified. Maturity risk premium is the extra yield, the premium, you earn from buying a bond with a longer time to maturity. This notion of maturity risk premium exists any time you have an investment that pays a fixed interest rate and has a fixed maturity date. Is there some way to quantify maturity risk premium so you can compare apples to apples? Yes. This risk premium can be quantified by comparing your chosen investment with investments with different maturities. Say your bank pays 1% interest on a 2-year certificate of deposit and 3% on a 6-year certificate of deposit. You earn an extra 2 percentage points more per year and 3 times the original interest rate for tying up your money for 3 times as long. We see a real-world example looking at government bonds. The yield on the 20-year Treasury recently was 2.33%, just when the yield on the 30-year bond was 2.59%. Is it worth it to you to earn an extra 0.26% per year for giving the government a loan for those extra 10 years? Unlikely. When this spread narrows too much between 10-year bonds and 30-year bonds, it prompts worries of a flattening yield curve, meaning the 30-year return is unimpressively higher than the return on the 10-year bond, on a chart plotting the curve of interest rates for 10s versus 30s. An inverted yield curve, when shorter-term bonds are paying higher rates than 30-year bonds, makes investors worry that recession is nigh. Now, how can you assess maturity risk premium if you don't know which way interest rates may go? That's the trickiest part of the deal. What we do know is this: interest rates have spent recent years at 40-year lows. They are more likely to rise than fall at this point. Consequently, you should be careful about locking yourself into long-term maturities in the present environment. That is why many managers suggest you build a bond ladder. In a bond ladder, you buy bonds with differing maturity dates, short-term, medium-term, and long-term, in regard to when they come due, so that they form a ladder of tiered payouts spread over different spans of time. Bonds that mature in 2 months, 3 months, 4 months, 1 year, 2 years, and so on, offer a panoply of payout possibilities. As maturity dates arrive, you roll over the bond and buy it again at the same maturity. If interest rates have risen, you will take advantage of that because the newest bonds you acquire will offer the higher rates. Interest rate risk is another factor that bears watching warily. Most conservative investors focus on a bond's yield and get excited when it is high compared with other investments' returns. Let's say you bought a 10-year, $1,000 bond today at a coupon rate of 5% per year, and interest rates in the meantime rise to 7%. What you once thought was a great coupon isn't looking so great anymore. Rising interest rates make new bonds more attractive because they earn a higher coupon rate. Thus, another phrase for interest rate risk is opportunity risk, meaning there's a risk that a better deal will appear and you can't take advantage of it. Thus, the longer the term of your bond, the greater the chance that interest rates elsewhere will rise in the meantime, sending your bond price down and costing you a shot at a newer, higher-rate bond. It gets worse. Let's say you need to sell your 5% bond prior to maturity. If interest rates are higher, you now must compete with bonds paying a higher interest rate. This will decrease demand for bonds at 5%, forcing you to sell it below par or less than you paid for it. The price gets pushed down. The longer the duration of your bond, the more volatility it will experience in price. Any suggestion that interest rates may rise could send the price of your long-term bond down significantly. That is yet another reason why long-term bonds earn higher interest rates, because there is more risk the bond price will decline over time. Bond fund managers face the same risks as individual bondholders. When interest rates rise, especially when they go up sharply in a short period of time, the value of the fund's existing bonds drops, which can put a drag on overall fund performance. Historically, we see interest rates rise when the economy is growing robustly and prices generally are on the rise, and we see rates decline in downturns. That's because in bad times, business demand for credit is slack, and banks' willingness to lend is scant, so the government tries to induce businesses to invest by cutting interest rates to make borrowing cheaper. Also, rising inflation leads to rising interest rates, and declining inflation leads to lower interest rates. Reinvestment risk, the third kind of bond risk, is the threat of interest rates going down and investors having to reinvest their principal or their bond income at a lower interest rate than before. Suppose you buy a bond paying 5%. Reinvestment risk will affect you if interest rates drop and you have to reinvest the regular interest payments at 4%. Reinvestment risk will also apply if the bond matures and you have to reinvest the principal at less than 5%. Reinvestment risk will not apply if you intend to spend the regular interest payments or the principal at maturity. Liquidity risk is the risk that if you need to sell in a hurry, you could be unable to find a buyer. This risk rises when smaller companies sell corporate bond issues that are so thinly traded that finding a rare buyer for your bond may require lowering your price even more than you had planned. Rating downgrade risk is the risk that while you hold a bond, one of the big ratings agency will downgrade that company's credit rating, which could raise uncertainty about the company's ability to finance operations and generate cash to pay its bond payments as required. The price of your bond could fall instantly, causing a loss if you end up selling. Credit default risk is the ever-present possibility that the bond you bought might default, and the money you offered up front will never get paid back. For bonds overall, this risk is rather low, yet the mere fear of interest rate swings can spook investors and cause them to flinch and sell, sending bond prices down as much as any real shift in rates on any given day. When you buy a $100,000 Treasury bond that promises to pay you 2% interest annually for 10 years, you may feel confident that your rate of return is 2%. In fact, it is something less than that, once you factor in advisor fees, taxes, and other rogue interlopers that take their cut before you get to your real bottom line. Never mind that Capital One ad slogan, "What's in your wallet?" The better question is, what's your real rate of return? The next chapter will explain that.